Hello, everyone. Thank you for joining the Financial Literacy Series. So this is the finals. I took off the waiting room feature so that everyone can come in. This is where we'll announce our team that won the financial stock game that we were running. We have Anthea Perkinson here to present again. We want to welcome everybody back. And Anthea, whenever you're ready, you can take it.
Okay, you see the presentation?
Yes.
Perfect. Okay. Thank you very much for having me back. This is the final presentation in this series. We've covered a lot of topics, including investing. That was our first presentation. Then we talked about taxes. We've talked about student loans and managing debt. And last, I would like to share with you a presentation about managing your finances in an emergency or major life transition. And in this, we'll talk a little bit about putting together a budget and managing credit and your credit report. Straightforward agenda. We're going to talk about setting financial priorities, the benefits of a spending plan, places to find money, how to expand your spending power, managing credit, and accessing investment accounts. A little bit back to the tax conversation we had a couple weeks ago. Before we begin, let's talk about what an emergency or life transition actually is. Bottom line, what I'm referring to here is any event that could negatively impact your current and future financial stability. So we've all been through the pandemic, seems to be receding now, like a bad dream for 2 years, but that took a serious toll on a lot of people's financial security. Another situation would be if any of us got sick or badly injured, losing our ability to work, earn a paycheck. That could be a really tough situation. Same thing if your partner, your parent, your child gets sick or badly injured and you have to step in and care for that individual. That could have a major impact on your finances. Death of a spouse or partner, or a divorce from a spouse or partner. What makes these particularly difficult is that in all of these situations, you have the intersection of money and emotions. In most of these situations, you are probably near panicked. You're not necessarily thinking straight. It's very emotional and kind of wrenching. So to help get through this, it's really beneficial to kind of think through, well, what would I do if? How would I navigate if something like that happened to me? Because being prepared is being in a much better position to make good financial decisions. Talking about financial priorities, most of us pre-emergency are lifestyle focused, and we're thinking about, will I take a vacation this year? Do I have enough money to buy a whole new spring wardrobe? How about my car? Do I need to think about that? Maybe I want to upgrade it if it's leased and will be coming off a lease in a year or two. So, that's how most of us go around thinking. How are we presently living? Are we in good shape? Are we able to achieve these lifestyle type goals? Now, when a crisis hits, a lot of people, as soon as they realize there is a financial impact, are much more focused on financial security and solvency. And what is solvency? It's the ability to continue paying your bills. So if you were injured, or if you had a terrible medical diagnosis, or this happens to a spouse or to a child, suddenly these problems, these concerns are front and center. Very hard to make good decisions when you are in that state of emotion. Obviously, once the emergency is passed, you repair, you rebuild, you renew your finances. So in an emergency, let's talk about what financial security would be. It's a sense that you can navigate this, that you can make decisions that won't run through your savings, that you've got access to additional monies. You'll be able to pay your bills and stay solvent. And I will tell you that in that kind of a situation, feeling like you are in control over your finances because you have savings, because you have access to credit, because you might be able to tap your retirement account, for example, feeling that control is going to enhance your emotional and financial well-being. You've got a plan. You've got assets that you can fall back on. So in that horrible moment, as you're grappling with this, what are we going to do to improve our situation, make sure we can continue paying our bills? Number one, we're going to plan our future spending. Basically, we're going to put together a budget to kind of get through this very difficult situation. We're actually going to sit and think about the worst case scenario. When I read profiles of financial planning for people who families who are going through, for example, cancer treatment, terrible diagnosis, a lot of bills, a lot of anxiety about, the breadwinner suffering like this. I realize that it is very helpful to kind of think in advance about what would be the worst outcome and how do we make sure that we're protected against that. Getting our paperwork in order, for example. Think about what you would do if this suddenly happened to you. Who would you lean on? It's not just money, but it would be very helpful for all of us to identify a calm, rational source of advice, a friend or family member who could kind of be level-headed while you are in this initial panic mode. Super helpful. The other thing to consider and to avoid is beating ourselves up. In that situation, you will make emotional decisions that will have an impact on your finances. If it tends to be negative, it's not helpful to beat ourselves up and to sit and ruminate and regret over that. We can all work and try to do better going forward. So step one in exerting control over your money in this tough situation, make a new spending plan. This is basically a better term for putting together a budget. When you're putting this together, you're going to be very focused on essential expenditures. So you're not talking about vacation. You're talking about how we're covering rent, food, cell phones, medical care, the stuff you need to get through this difficult patch. You want to preserve cash in that situation. A lot of people panic, they spend down their cash savings, and then things really get tough. You are pushed into debt, you are out, soliciting loans from friends and family, and it's very, very challenging. So let's make this very simple. How do we know we can do this? Well, because we've done it already. If we look back at what all of us did during the pandemic, remember lockdown? Remember what it was like back in April 2020? In March, the global pandemic is announced. And by April, we were all sitting home wondering what's going to happen. And virtually everyone at that point was too scared to spend. Now, obviously, as time wore on and people got used to this, you started seeing all kinds of uptick in online shopping, and people were buying all sorts of stuff to enhance their stay-at-home experiences. But in April, we were pretty scared. And most of us really pared back our spending. And if you look at your credit card statements from April of 2020, you're going to see this. During lockdown, most of us, maybe you had a little bit of takeout food, but even at that, it was probably modest compared to July 2020. People were feeling much more optimistic. People were back outside. They had outdoor dining. People were doing a little bit of travel, getting together with family. At that point, we had vaccinations. So things were beginning to seem like they were improving. So we know that we can really ratchet back our budgets and our spending. I mean, just think about all the things we did not spend money on in April 2020. If you did it once, you can do it again. So know and give yourself a pat on the back that, yeah, I've got a roadmap if I am in an emergency and I really need to scale it back, I know exactly, what to look at and where I'm going to reduce my spending. When we look and compare the April, to make the spending plan, really bare bones spending plan, look at your corresponding bank statements. So look at April 2020, assuming that all of your bills are paid out of one bank account, or maybe a savings and checking account at one particular bank. If you look and you simply add up all of your withdrawals, now very few people in April were going to ATMs, but some people did. You shop by debit, you did electronic or Zelle payments. That's the total amount of money that you spent in that month. And I can probably guarantee you that it was fairly low because we were all at home, worried about what was going to happen. That's your bare bones, what you need to spend to survive. Okay, and it compares in a rather interesting way to what we all started to spend again in July. You'll see, on average, much more money left our accounts in July than in April. So now you have a model for what to do in another emergency where you need to conserve cash and be very mindful of your spending. So what are we going to put in our emergency spending plan? Just the essentials, food and medicine being number one, keeping up with your health insurance and other insurance premiums, utilities, cell phone, internet, electric and gas, going to keep all that running, rent or mortgage. If you have debt, you want to at least stay even with it, even if that's just paying the minimums. Again, we're in a situation where we probably want to conserve cash for unexpected bills, whether they're medical bills, etc. So it's not terrible to just cover your minimums in that situation. Right now, student loans are on pause. As I've seen in the press that they may be paused again. Right now, they're supposed to come back online May 1, and there is a move, I believe, in Congress to extend it further and help more people. But during regular times, say 2 years from now, if you're in another different type of emergency, remember that you got to stay on top of your student loans or reach out and put them into forbearance. Again, same exercise we went through in 2020 when we were looking to preserve cash. Remember what it felt like, how long it was before the stimulus checks came out, before enhanced unemployment came out, and different groups of workers got access to enhanced unemployment at different times. And if you weren't working and you were waiting for that cash inflow, things got pretty tight. And so people were actively suspending gym memberships at the time, getting rid of subscriptions, dumping any kind of auto billing to just stop the spending, hold on to cash. All of this is still available to us. In fact, I was talking to a friend who was just going through his cable package again to try to reduce that further. So always an opportunity to change and reduce your spending. Next action. Now that we are preserving the money we have and reducing our expenses, there are some things that are nice to have that in a pinch you can ditch for a while. Cable TV, you don't need it every month. If you need to conserve cash, that can save you maybe $100 or so per month for a period when things are pretty tight. Landline telephones, these seem to be going away anyway, so you can join the trend. Getting rid of annual fee credit cards. If you're not using it, that could be a way to save that annual fee. And, if you live in the city, do you really need a car? There are a lot of people who have come out of the pandemic realizing, you know what, this thing is an albatross. I'm done with the parking tickets, the parking fees. I'd really rather not have the car. So again, if you need to really scale it back, these are things within your budget that you can revisit. Next, now that we've got our arms around our spending, how about finding some money? I love telling people about missingmoney.com. It's an aggregator website that takes you to the office of the state controller for about 27 different states, I think. And all you do is type in your name, your state, and your zip code, and it will tell you if there's money waiting for you, it's like a magic trick. You put your name in. You have to do it by state. So for anybody who maybe went to undergraduate college or university in a different state and then moved to New York to go to medical school or graduate school, do both states. What this often turns up are things like refunds from utility companies. If you move out of state or even within a state, you may not have left your forwarding address, and the return of your last payment ends up going to the office of the state controller. So the other things that gets reported here, unspent gift cards in New York, they are not allowed to expire anymore, so you can find them here. Tax returns that were never collected. Again, maybe you moved in the middle and you forgot that you had never collected your tax refund. So you can find that here. But one of the biggest things that I have found that people get really excited about, if you were the beneficiary of a life insurance policy and you didn't know, or of an annuity and you didn't know, and the owner of those policies died, the money, if they don't have your contact information, ends up with the state if they can't find you. And some of these insurance companies have actually gotten in trouble for not really trying that hard to find you. They're not allowed to keep the money. They have to report it and send it on to the state. And you can find it on this website. Another place you can potentially find more money, a lot of people are so close to not owing money that they simply don't file a tax return. And sometimes they would have been eligible for a refund. Taxes were taken out of their paycheck and they just never filed to get that refund. If you don't file, you don't get a refund. You can go back up to 3 years and claim a refund owed to you. And remember, with all of the different incentives that were put out there because of the pandemic in 2020, of course, in 2021, there may be more of a refund than you were expecting. Same thing if you didn't get your stimulus check. If you didn't get it as it was mailed out, the only way to claim it is to file a tax return and claim it. If you have a dependent kid who had earnings, actually 2019, 2020, or 2022, and they didn't make more than, say, about $12,400, that is the standard deduction for an individual going back 2 years, $12,400. So if they had a little part-time job, they got a W-2, they had state and federal taxes taken out, they can file, indicate that they are dependent on your tax return, and get back the federal withholding and also the New York State withholding. So now that's a little windfall for them, which could be rather nice. If you may have been eligible for the earned income tax credit 3 years back and you didn't file a 1040, you may not have been required to do a tax return because you didn't earn quite enough money. It's in your best interest. The earned income tax credit is fully refundable, meaning that even if you didn't owe federal income tax, if you were eligible for the earned income tax credit because you were working and you have children, dependents, you can actually get a check. So it's worth looking into if you were in that situation. This is the website that you will go to. If you go to missingmoney.com and you indicate that your state is New York, this is where you end up. And look how much money. There's $16.5 billion in unclaimed funds. And in 2020, they returned $261 million. So some of this could be yours. Well worth a look, and make sure. And Find out if any of your friends or relatives have money sitting here. I mean, money ends up with the state for all kinds of bizarre reasons, and who doesn't like a windfall? So other places you could look to find money that belongs to you. A lot of people use Venmo, and then they stop using Venmo and they forget that that money is still sitting in there. It's not technically in their bank account. So if it's sitting there, you can transfer it. Now you have more money in the bank. Credit card reward balances. I was talking to a client the other day, and it turned out he had the equivalent of $2,800 in reward dollars. And he was going to apply that to his balance for his business. And all of these expenses were for buying inventory. And I said, wait a minute, you are, scraping along, get that check and put it into your personal checking account. Have some money in the bank. We're going to work on your business, and that balance will be taken care of, but you are the beneficiary and could use the reward balance dollars. If you have gift cards, and so many people get gift cards, lose track of them, they end up in a drawer. The Money Pantry has a whole collection of ideas and reviews of places where you can sell gift cards. These things are very transferable, even if you've used a little bit of it. There are people out there who want to bid on them. So everything from like GameStop to Amazon cards to Apple cards, all of this stuff. And then of course, retail merchandisers, people are willing to buy these, usually at a discount, but you get cash for a gift card that you will maybe never use. Other places to find money. I have one example of a rebate program. Obviously, there are multiple rebate programs out there that you could look at. There's Rokutan, there's Ibotta. Upromise is an interesting one. It's for online shopping. So their partner companies, which would include Macy's, Apple, lots of restaurants. You go online and you do your shopping through your Upromise account. Costs nothing to sign up. You register your credit cards. So as you go through your Upromise account and you buy something on the Macy's website, you can earn a percentage of your purchases back. It comes back to you as cash. They also have, which is really kind of fun in New York, dining and takeout rebates. So for those of us who like to eat out or do takeout online, you can get money back. So the way I like to think about it is you take your cash back credit card, you register it on your cash back Upromise account, and you more or less double dip. You get money back in two places. You're not just restricted to linking your own cards. If you're married, or if you have a partner or friends or relatives who want to help out, you can register those cards too. And as they go about doing their shopping and dining out in participating places, that money gets credited to your account. Now, when this was originally set up, they were focused only on building savings in 529 plans toward college education, which is noble, right? That's a good idea. But not everybody is saving for future college tuition. You can attach it to your checking account. I used to have my Upromise account attached to my son's 529. He's now out of college, and now it's going into my checking account. I haven't signed up for the Upromise MasterCard, but they often accelerate or give bonuses for using their branded card. And
excuse me, Anthea, we had a quick question from Dr. Menzel. Dr. Menzel,
sure.
can you come off mute and ask your question directly?
Hello, can you hear me?
Yes, I can. Thank you.
Yes, I just had a quick question. Not to sound silly, but I think I saw websites like, claim your unclaimed funds. And I used to think it was a scam. And I was always saying, like, this is how they get people. You put in your social security to track how much money you have, and then boom, somebody like uses your social security for fraud or something. So is there any way, are these the only official sites to use to find unclaimed funds, or there's other ones and we should just be wary on not getting trapped?
So that is an excellent question. Missingmoney.com, when you go in through missingmoney.com and you indicate the state, it dumps you into the official Office of the State Controller for New York. And this is legit. This is a government website, and you can go in here, you kind of repeat your search. And when you indicate that, hey, I think this money belongs to me, it walks you through the process of how to claim it. It's not automatic. It's not quite like a slot machine. You have to submit documentation, prove that you're you, prove that you recognize the funds. And when they match you and this money, they send you a check. But you're right to be suspicious. There are efforts to get unwitting people to put their social security number in here. So unless you know you're on the state comptroller's website, be cautious. It should look like a government website before you give that sensitive information. Thank you for asking that question. Okay, so this is just an overview of what's on the uPromise website. Here's a sampling, and this is a little bit dated. The big retailers that have the enhanced cash back change all the time. And you can see that it's a pretty broad range of retail stores. There's travel on here. There's Apple, for example. So it's worth looking at to see if you can not only save money, but also get money back by registering your cards. They had a restaurant rally, and these were my earnings for the summer of 2020, getting money back on local restaurants where we were doing takeout that were participating in uPromise. So it's not nothing, $20.75 on takeout food that I was going to buy anyway. That was pretty good. And it was a cashback card anyway, so I was getting credit from the credit card itself. So different ways to think about this stuff. It is a way that you can, without a whole lot of effort, accumulate more cash savings. Next thing I want to turn to, when you are anticipating a tough period, again, the unexpected bad medical diagnosis or, a potential divorce, you want to think about, how am I going to have access to more money? How can I expand my spending power? One of the ways to do that is to increase your access to credit. You may want to consider extending your credit limits. So say you have a credit card and it's been fine. You have access to $5,000 in total credit. You barely use it because you use this for your day-to-day spending. Well, if you're anticipating, maybe a parent getting sick and you're going to have to do a lot of flying back and forth to help, if they're out of state, maybe you want to expand the credit limit on your credit card so that you don't end up using more than half of your available credit. And we're going to talk about that in another minute. Having access to more credit means that you can take on this debt if you have to. You're not going to max out your card and be stuck. The other thing you can do if you see trouble on the horizon is apply for a 0% interest credit card. Now, most people think of these 0% interest credit cards for transferring balances. It's a great way to get out of debt. So, you've got high interest credit card, you got a balance on that card. You apply for a 0% interest credit card. Right now, they offer up to 18 months, 0% interest. You pay a fee. It's around 2.8% of the balance transferred. You put it on ice on this card and you pay it down over the 18 months and hopefully pay no more interest on it. They also have 0% interest cards for new purchases. So if you think, for example, that you might have to pay for airline tickets to go back home and, help out an aging parent or whatever. A 0% interest credit card lets you kind of float this while you're sorting things out. You don't have to pay interest on it. You put the purchase on it, doesn't grow at interest. You have a period of time you can carry it like that before you pay it off, or it starts accruing interest. That can be super helpful in an emergency. If you're looking at big challenges, and again, the terrible diagnosis, doing a cash out home equity loan can be helpful, or getting a home equity line of credit if you own your condo or your home. This can be a way to have just another source of emergency money. You may not need it, but it's good to have it in case you do. Other ways to expand your spending power, just want to talk about refinancing home mortgages. If you refinance, so when you take out a mortgage, say you take out a $300,000 mortgage at a stated rate of interest, 30-year period, over time, say if it's a 30-year period, maybe you're 10 years into it, you now have a much lower principal balance. If you were to refinance that mortgage at a lower interest rate and go back out 30 years, you're going to end up with a lower monthly payment. That could be really helpful in terms of having more free cash flow. You can also do what's called a cash out refinance. You get a lower interest rate than what you're currently paying on your loan. And rather than refinance the current balance, maybe you refinance your original amount. So say after 10 years in this situation, first situation, you borrowed $300,000. After 10 years, you still owe about 120. Here, and you refinance that for 30 years, you'll have a much lower payment. In this case, you refinance the original 300,000, but with a lower interest rate, and you owe so much less on it because your actual balance was 120, you have access to that cash for the same monthly payment you're making now. Now you can take that cash and hold it for emergency use, put it in the bank, see what happens. If the emergency clears, if you were to use that cash for renovations, you can take in an interest deduction, a mortgage interest deduction for using it for renovations. Okay, so again, another way to find money that you might need in an emergency. Use credit to avoid spending down savings. So you're in a tough spot, consider paying only the minimums on your credit cards. It's a temporary solution. Obviously, this doesn't get you out of debt, but you hold on to the cash in the bank. Do consider transferring high interest balances to a 0% interest transfer card so that, again, you can hold on to cash. And as I mentioned before, the 0% interest on new purchases card. Where do you shop for these types of credit card offers? Bankrate.com, NerdWallet, and Magnify Money are two financial product blogs. They do a best cards of the year type of review every year. So you can look at NerdWallet's best 0% interest cards or NerdWallet's best cash back cards and pick the card that works the best for your situation. A couple of words about managing credit. Talked about, leveraging credit to maintain cash in the bank, increasing your ability to borrow. So let's talk a minute about the difference between a credit report and a credit score. So your credit report, anybody who's used credit in any fashion has a detailed history of all loans and repayment activity, whether you borrowed money or you accessed credit using credit cards, store cards, bank loans, student loans, car leases, car loans. All of that information is on our credit reports, along with our payment history. If our payments were in full on time, that is marked on our credit report. If we've gotten into trouble, if we've forgot a payment, if we have gone into default, which means you haven't made a payment in 90 days, if you've ever been taken to court for non-payment of a debt, this information is found on a credit report. A credit score is a number between 300 and 850 that summarizes the activity on a credit report. And I'm going to show you a little pie chart how that number is actually derived. And the reason that Fair Isaac Corporation invented the FICO score back in the 70s was to help mortgage lenders predict who was a good credit risk and would pay back a 30-year mortgage. That was the first reason that credit scores were developed. And that first one that was developed was called the FICO score. Now there are many different types of credit scores. You've probably heard of Vantage scores. They work the same way, runs from 300 to 850, as you see here for the FICO score. And the Vantage score is used in a lot of consumer lending. So you might see a Vantage score used for an auto lease, for example, or other types of consumer debt, applications for credit cards. So these scores are used to predict the future repayment behavior of borrowers. Therefore, they are used to price the cost of credit, meaning the interest rates charged. If you are somebody with a high credit score, you are viewed as having great credit and you will get a lower interest rate because you're a low risk. If you have a poor score or a middling score, you're going to pay a higher interest rate because the lenders feel that there is a greater chance that you'll have trouble keeping up with the payments and that you won't be able to fully pay off whatever money you borrow or charge. How do we get a credit report? It's very important that each of us look at our credit report, preferably one time per year, to make sure that it's accurate. You know, if you think about how sensitive the information is that's on a credit report, it's got our biographical information, not just our name, social security number, date of birth, but all the places we've lived for the past 10 years, all of the types of borrowing that we've done, our credit cards, balances, whether we pay our bills, sensitive stuff. We'd like to know that this is accurate, right? So each of us can go to annualcreditreport.com. This website was mandated by Congress in 2003 under the Fair Credit Act. And when you go here, it is a site where you can access the 3 credit rating agencies, Experian, Equifax, and TransUnion. Now, what's very important, do not Google annualcreditreport.com. Type that into your browser. And I say that because there are dozens of fraudulent websites that look like annualcreditreport.com, but what they are sites that capture your personal information. You are going to type in your social security number, your current address, your date of birth. Then they're going to turn around and ask for a credit card number. And they're going to sell you some credit monitoring service that you don't want or need. So make sure you're on creditreport.com. You will be hyperlinked to one of these sites. So you go directly to one of these 3 agencies' actual website, because it's a hyperlink, you know, nobody is going to capture any of your information. Now, once you get there, say you get to the Experian website, you're not home free and able to just download your credit report. They have to prove that you're you, or you have to prove that you're you. They're going to give you a little quiz, 7 questions generally, and you have to answer each of them, proving that you're you. And if you are successful, you'll get access to your credit report. These questions are based on information on your credit report. So you may be asked, what is the lease payment amount for your Ford Explorer? And you either know that answer and can find that answer in the dropdown, or you realize, I don't have a Ford Explorer, and you indicate that it does not apply. You have to be able to answer all the questions correctly in order to get access to your report. If you fail the quiz, you either have to call this number down here and go through this on the phone, or there is a form, which is more or less an affidavit proving your identity. When you mail in the form, they'll mail back your credit report. Okay. Now, your credit report does not have your credit score. Most people are very disappointed. That's what the information they really want is, what's my credit score? That's what determines my cost of credit, my interest rates. That's what I want to focus on. Most of us can now get our actual FICO score from our banks, all the major banks, Bank of America, Chase. If you have an online bank account, you can go online and look at your FICO score. USAA, the credit union, also offers this. I'm pretty sure Wells Fargo offers this. So you go online, you can get your FICO, and you can check that as often as you want. It has no impact on your credit score. If you don't have a bank, and some people work with small community banks, so they don't have a national account or a national bank that is presently offering a FICO, you can get an estimate of your FICO score from creditkarma.com. You don't have to buy anything. You can just look it up. They have great information about managing your credit score, but for the most part, none of their services and products are stuff you need to pay for. Their ideas and recommendations for improving your credit score are pretty good, but you don't have to buy anything.
Yeah, I have a question.
Yes.
I wanted to note that yes, on Chase, on the option they ask you, do you want to see a credit journey? You click that and they'll give you your credit score. So I
Yes.
did know that recently. The other question was, can you speak to the possibilities if there's any benefit taking out a loan against your retirement plan with your say with your employer? How does that work? Do you think that's a good tactic or not?
Sure. Yeah, if you're in an emergency, taking out a loan can be a very good idea. Actually have that further on in the presentation, but I'll address it here since it's an active question. There are sort of two caveats for taking out a loan. One is if you leave your job for any reason and you have an outstanding loan, you may have a very small opportunity to pay it back, once you're no longer employed by that employer. If you are unable to pay it back, if you leave your job, it's counted as taxable income. And if you're under age 59 and a half, you also have to pay a 10% penalty tax. So that can be a challenge. So, you take out a loan thinking, okay, I'm going to pay this back because I'm going to continue to work here. It'll come out of my paycheck, pretty easy, paying the interest to myself. This is not that bad. Now you're not working and you have a tax bill. So that's one consideration. The other consideration for people who do this regularly, and I have coached a lot of people to stop doing this. They take loan after loan out of their 401k or 403b plan to make things work. And they're constantly repaying it. And they lose the power of compounding because the money is out of the account. So you spend all this time contributing into your retirement savings plan. If you keep borrowing from it, it's really not going to grow, and it's not going to be what you need it to be when you're ready to retire. So those are my two caveats. But if you're in a pinch, this can be a good place to get a loan that does not require a good credit report, good credit score. It's your money. You can borrow it and arrange to pay it back. Thank you for that question, though.
I have one more question.
Sure.
Because we're talking about using the advantages of like balance transfers and different ways to pay off debt. Can you speak to some of those programs where you sign up in agreement to pay off say a loan within say 36 months, but sometimes they charge you large amounts of interest in the earlier payments before you start getting to pay off the actual total balance? Is that a disadvantage?
That's a huge disadvantage. If you add that initial payment, what you're talking about are like two financial whacks. They whack you with a big upfront fee for getting access to this loan. Then if you try to pay it back quickly, you got a windfall, or, now you're in a position where you can pay this back and stop paying this high interest. They charge you a prepayment penalty. So prepayment penalties are just universally bad. They never work for the consumer who wants to get out of an interest situation. A lot of the online loans, if you look at Cabbage for one, that's how this works. And people get really upside down in that situation. If you need a loan, my first recommendation is to find out if you have access to a credit union near you, near where you live or where you work. And the reason for that is, for the most part, you can join credit unions if you meet their membership class. It takes very little money to open an account and become a member, $25 in some cases. And then you're a member and you get member pricing on consumer loans. And consumer loans can be much cheaper, like 7% and no origination fee, or a very modest origination fee. So that is often a much better deal than a lot of that stuff that is heavily marketed online. But I'm glad you brought that up, because I have worked with a few people who've really gotten in trouble with the online borrowing stuff. Okay, so managing credit, when we get our credit report, say we have no trouble passing that little quiz. So we print out our Experian credit report. We want to look at how information is presented. It's the same on all three. So regardless which credit bureau you print out, you start with your biographical information. So it's our full name, our full mailing address, date of birth, last 4 digits of our social security number, 10 years of addresses where we've lived. One or two of them indicate who you're working for and whether you own or rent your home. When you go through it, make sure that all of that is 100% correct. Be very suspicious if you see any addresses where you have not lived. You want to challenge that information on that credit agency's website. So it used to be you had to mail in a letter and it was a whole thing and it took forever. Now you can go online, so you get back on the Experian website and you file a challenge to information that's on your report. If you see anything that's incorrect, and it can be all sorts of stuff, your date of birth is wrong, your addresses are wrong, unfamiliar credit accounts, like I don't have a credit card from that company, or I didn't have a car loan, challenge it. So submit this online. They have 22 days to respond to you. And then if they find in their research that it doesn't belong to you, they'll send you a new copy of your credit report with that amount of that information missing. It's very important that the information on our credit reports is 100% accurate. This is the place where most people find out that they have been a victim of identity theft. They go on and they find a student loan that they didn't sign up for. They find a mortgage they never applied for, credit cards that they've never heard of. So make sure to give it a look. Okay. Negative accounts. So say you go on there, onto your credit report, and you see, gee whiz, forgot about that credit card, when I got out of school, wasn't working, I kind of left a balance and I walked away from it. So a negative account in the state of New York will stay on your report, consumer loans, credit card debt, for 6 years, and then it falls off. And so if you are approaching 6 years, if you do anything about it, if you reach out to repay it, it stays on there another 6 years. So I'm not saying you're to do anything unethical, but know that there are consequences to resolving these if they are old, okay? And negative information if it's getting older, particularly if you're about to apply for long-term credit, like a mortgage or a car loan. You know, sometimes you're better off leaving it alone, because every year a negative item is on your credit report, it weighs a little bit less on your credit score. It literally ages off. This is why, for example, if you know anybody who's ever been through a foreclosure or a bankruptcy, bankruptcies can be on your credit report for 10 years. Eventually, those 10 years are over and that information is gone. But even during that period, about midway through the 10 years, so in year 5, they have access to credit again, because again, that information weighs less and less on their credit score. Now, they get credit again if they are using it properly, if they are borrowing and paying it back. Then you basically renew your credit profile, and hopefully things turn and you stay current with your bills. I mentioned that I would share with you how credit scores break down. And this is powerful information. Once you know how this works, you know how to use your credit score to your advantage, and you will know how to improve it without paying anybody to do that for you. So the biggest chunk of our credit scores is represented by our payment history. So how well in the past have we paid our various types of loans? Our student loans, our mortgages, our credit cards, whatever it is. If you've paid these in full on time, that's worth 35%. This one, the amount owed ratio, also called the credit utilization ratio. This is the secret sauce. This is what the credit card companies generally don't want us to know how it works, because it is easily manipulated. 30% of our scores is represented by how much of our credit limit we actually use. And it's kind of counterintuitive, but say you had a credit card and you had $2,000, a $2,000 credit limit. And every month, because you get miles or cash rebates on this card, you put everything on this card. So every month you put, $1,900 on it. You pay it off every month. You've got good cash flows. You pay off $1,900. It's back to zero the following month. You do the same thing. You are actually harming your credit score by using your card in this fashion. If you use more than 50% of your available credit limit, it lowers your credit score. Again, this seems kind of crazy because you're paying it off every month, but this is how they watch what you're doing. You look like you might have cash flow issues if you're maxing your card every month. So what do you do instead? Use 50% or less. If you have a card with a limit of $2,000 and you want to spend $1,900, if you've got income, you've been a good customer, you can call them up and increase the limit. Ask them to push the limit up to $3,200, and that way you should be able to more easily stay around 50% of your credit. Now this works card by card. It also works across all of your cards. So having multiple cards can kind of help you out from a credit limit standpoint. This is one of the reasons why canceling credit cards can really damage your credit score short term. Because maybe you have a card and it's got, $5,000 limit on it, you never use it, you just cancel it. Well, you have $5,000 of available credit that's now not available to you. And if you're using your other cards heavily, you now may be over that 50% and your credit score goes down as a consequence. Your length of credit history is meaningful. And obviously the longer the better. If you've had a card since, the 90s, that's a long time. And that's worth 50%. You've been at the credit and repayment, borrowing and repayment game for a while, and that's a positive 15% of your score. This is why older Americans tend to have higher credit than younger Americans. They've been at it longer. Now, these two, this application for new credit and length of credit history, can be interrelated. It's not bad to apply for new credit. You can add to your cards. I wouldn't do it before you're about to go in and, sign a mortgage note, but adding a new card is not a bad thing to do. But here's what happens. When you get a new card, you have a brand new baby card with 0 years of history. It gets added and an average is taken. So you've had a card from the 90s and you have a card from yesterday. 0 plus, 30 is now only 15. So you've shortened your average length of credit history. And that is a temporary ding. So these become temporarily a negative weighting in your score. It's timing more than anything. This reverses itself. There's no reason to carry cards forever that you do not want to use. But if you know that you're going to be signing a new car lease or a new loan of any kind, hold off on canceling the card or applying for a new one. Mix of credit. It's not that some types of credit are better than others. The types of credit include revolving credit, which are your credit cards. Every month you might owe a different amount of money depending on what you're spending and using your card for. So that's why it's called revolving credit. The other type of credit is installment loan credit. So any kind of loan payment that stays the same, mortgage, student loan, car loan. You make the same payment, due the same day of the month for the term of the loan. Having both gives you a more robust picture of your credit use. And so as a consequence, you get a 10% bump for having that greater picture, that more robust picture. Again, this is why older Americans tend to have higher credit scores. It's because we have mortgages and car loans and credit cards. Other places to look for help for improving credit. American Express has score goals, and they kind of coach you through how to raise your credit score. Obviously, it's geared for people who have an American Express card. I mentioned Credit Karma earlier. You don't have to pay for anything. You can use their hints and tips. They've got actually some very good content on their website and great suggestions for moving your score higher. Now, quick note on accessing investment accounts. In an emergency, you may want to tap your various accounts. And what I want you to think about before you do that are the immediate tax consequences of withdrawals. Anthony asked about what happens if you take a loan. Well, a loan, you're protected. That stays tax deferred. You repay it, goes back into your account, you're good. If you take even an emergency withdrawal from your retirement account, and this is permitted in certain situations, medical emergency being one, housing emergency being another. If you take this out, you do have to pay income taxes on it. And you do have to pay the 10% excise tax. And if you take a withdrawal, you have no ability to put that money back into that account. Now, you can take a withdrawal of a 401k, a hardship withdrawal, they call it, from your 401k or 403b. You cannot do that from a traditional IRA. If you need money out of your retirement savings and your choice is your IRA, you can simply close it. Unless you are of retirement age, they don't give you withdrawals. So you would have to take the whole amount, pay the taxes on it, pay the excise tax, that additional 10% if you're not age 59 and a half. So, and that could be a painful way to access money. Now, if you have a taxable brokerage or mutual fund account, one of the things that is true, if you've held the investments in here, so going back to our discussions of both investing and tax calculations, if you have long-term holdings, investments you've held for more than a year, you would pay a capital gains tax, not a regular income tax, on taking money out of these types of holdings. So that could be reasonable. But if you wanted a tax-free way to access money in a pinch. Remember that your Roth IRA, you put in after-tax money, and it is growing tax-free forever and will be tax-free when you take it out after age 59 and a half. But you have the right, for whatever reason, to take your contributions out. Now, the pinch is there's no tax consequences. This money is yours, no question asked, but you can't put it back in. So say over 10 years, you ended up putting in $60,000. It's grown, maybe now the whole account is worth 100,000. You could take your 60 out, but you are restricted to putting in only $6,000 a year, and you have to have earned income in the tax year that you do it. So it's going to be very hard for you to replace that $60,000. You set yourself back pretty hard. Loss of compounding. This is the big, unseen, unrecognized threat of taking money out of your investing accounts. The reason 401k, 403b accounts are so powerful as ways to save for the future and to fund your retirement is you put money in, that money earns money. The money that money earns money. That is compounding. You take money out, it doesn't happen anymore. The magic is gone, and you can set yourself back and really put your future retirement at jeopardy. So just be cautious about that. We talked about borrowing from retirement accounts. It can be a good way with, no credit score necessary to get money. But again, just remember, this should be a last resort. I do meet lots and lots of young people who have just raided their retirement savings time after time, sometimes for no great reason. And they will be among my clients who will be working well into their 70s. So just bear that in mind. If you don't put away money for the future, you'll continue to work to be able to pay your bills. I mentioned tax loss harvesting when we were doing our investment program, but just a reminder here, if you were to take money out, say you sold a winning stock because you needed some money, you can also sell a losing stock or fund or ETF, and the gains and losses will offset themselves. And that will help you manage the tax implications from selling your winning investment. Remember the difference between long-term, you've owned it a year and a day, versus short-term, you've owned it for less than a year. Long-term, get the preferential capital gains tax rates. Short-term gets taxed like regular income, which can be a bit painful. So in summary, in an emergency or potential emergency, consider what your financial priorities are. Create or update a spending plan, always good in some form of life transition or emergency to just write down a budget. Look for money. We've shown you some places to go. Manage your credit report and score. Don't wait till an emergency. This is an important thing to do just in managing your finances generally, but it's critical if you're in a pinch. If you access investment accounts, be tax aware. So I'm going to take a couple of questions, and then we're going to go to the results of the investing contest. You'll get a copy of this, a PDF copy of this presentation, so you don't have to write these all down, but I've included places to learn more about personal finance. And what I'd like to say to you, it's hard to become a financial expert on all the topics that we've covered in just a month. You can spend years learning this. In fact, one of the best ways to become great at personal finance is to read a little bit about it, every week. Places that I like to send people, Kiplinger's, Wall Street Journal, they've got great personal finance articles, particularly in the Saturday edition. New York Times, they have great personal finance writers. And Karen, Ron Lieber do a great job. They cover everything from student loans to, how to refinance your mortgage. It's all in there. And it's great to read it over time. It's overwhelming to get it all at once. The investing websites, these are all good places to look to learn more about investing. Your Guide to Successful and Secure Retirement. It's comprehensive. I'll warn you up front. It's a lot, but it's one of the best that I've ever read. And in my line of work, I read a lot of these various guides to investing and planning for retirement. So that is the end of our course, and I'll take any questions, and then we're going to look at the 2 portfolios that were submitted for the contest.
Yes, if anybody has any questions, please use the raise your hand function. I believe on the computer, it's under reactions. On your phone, if you hit the bottom left icon, the bottom right icon for more, it'll say raise your hand. In the meantime, I have a question for you.
Yes.
Why does it appear that most banks don't offer the ability to consolidate all of your outstanding credit card debt and you just pay one person monthly, some type of monthly minimum to get out of debt?
Because they are in the mortgage lending business, and fewer of them are in the personal loan business. They got in trouble after the great financial crisis for how they treated their credit card holders, their customers. And so a lot of them have been chastened, and they've gotten out of consumer lending for that reason. They've sold off, some of them sold off their credit cards, and they got out of the whole business altogether. So it is better if you're looking for a personal loan or consolidation loan, you can still get them at a credit union. They're in that business. They have them if you look at bankrate.com. Some of them are online lenders, so the rates and terms can vary quite considerably. Even if you're looking at a place like Bankrate, you'll notice it's kind of all over the map what it would cost. So that's generally why I send people to credit unions. And I think you have access to one through the university. And if you don't, there's some great ones in the city.
Okay, and my last question, in the era of the new currency of NFTs and cryptocurrency, Bitcoins, is there really a future for people or millennials thinking that they can stop working regular 9-to-5s and somehow make millions from these investment platforms?
So you're talking about the FIRE movement, people who want to live frugally and retire early. This is a phenomenon. I think that some of them, depending on how they have deployed their assets, like if they thought that they would be able to invest and have $1 million portfolio and be able to live on that for the next 70 years, I don't think that works, and I think that if your goal is to become a cryptocurrency millionaire and make that work, there's too much uncertainty. And in fact, I'm going to show you the first of the 2 portfolios. And what I want to point out is we've only been investing for a month, and both accounts, both of the investment portfolios are down because we can't control what happens in the world. We have this Russia-Ukraine situation, which may become an open war. We don't know. And as a consequence, the markets are really rattled. And so I think that thinking that you can become, independently wealthy and manage that portfolio for so many decades without working and earning a paycheck is a little bit naive. The other thing that people don't think about is how Social Security works. If you don't work and contribute for at least 10 years, you don't get a benefit. You get nothing. And you have to contribute at least a modest amount during those 10 years. You have to have, I think it's less than $1,700 in earnings per quarter, but you've got to earn for 10 years to be eligible for anything. And a lot of people in retirement Social Security is the difference between making it on their savings and not, because Social Security is indexed for inflation. People are only now talking about inflation because suddenly we see it. We haven't seen inflation since, 2006, because after the great financial crisis, we went through a tremendously deflationary period. Interest rates came down regularly to the point where nobody is earning any money on savings in the bank. And now we have food and energy prices that are up dramatically. I think it was January, inflation was clocked at 7.5%. So if you don't have a source of income that's indexed to inflation, like Social Security, it could be pretty grim in your later years. So that is my counsel. I think that in reality, a lot of these retire young millionaires do dabble in paid work, whether they're influencers online and they run blogs that earn money. I don't think they actually stop working, most of them who are successful. But there are a lot of things to think about before you elect that lifestyle.
Okay, thank you.
You're welcome. I'll get off my soapbox now.
If there's anybody else has any questions, if not, then we're gonna go to the breakdown of the portfolios.
Okay, so what I did, I took both portfolios. So for team one, we had their picks. They chose Microsoft, NVIDIA, Gold, which is Barrick Gold Corporation. It's a mining firm. They had Ethereum in here, so not really a stock. It's tracked like a stock. It's actually a cryptocurrency. They had XOP, which is an ETF that for mining and exploration companies. And they had Facebook. And I set this up that they invested $10,000 in each of these. We have S&P 500 as sort of our benchmark. How are we doing relative to the benchmark? And once I invested $10,000 using February 1st values, we saw that that got you 2.2 shares of the S&P 500, 32.45 shares of Microsoft, et cetera, et cetera. So how did we do? This is our cost basis. Okay. These were the original prices that I purchased at. And now we have today's prices. So you'll see that the S&P 500 is down more than 200 points. It is down 5% for the month. Microsoft, similarly, down 6.62% for the month. NVIDIA, much to my surprise, because we have such a crunch for the semiconductors, is down 5%. Gold is up. So gold, the Barrick Corporation is up. And what's interesting about that, it is a natural resource. It's a good thing to own in troubled times. It tends to be counter-cyclical. So when there is trouble in the world, gold stocks go up in value. But if this situation in Ukraine is resolved in a month, we can hope, you will see this likely sink back down. They are good in an emergency, but it's hard to make money long-term, much above the rate of inflation. So it's your winner in the portfolio for right now, but that's sort of what happens to gold stocks. Ethereum, one would think that this would have done super well, given what's going on in the world. But like everything else, it sank. Same thing for the mining and exploration. And much to our great surprise, the biggest loser was Facebook. And that is mostly due to the negative or really sad earnings results that they announced recently with their switch to Meta and loss of advertising. So they got pummeled pretty hard. One of the reasons a company like Facebook is going to get pummeled this hard is that it is such a mega cap. It has been a stock market darling for so long. It's owned in a lot of institutional portfolios. So a lot of pension funds, a lot of big actively and passively managed mutual funds own it. And when things go south, particularly the pension funds have to sell it. And that drives the price even lower. So is it likely to turn around? Yes, they seem to figure things out. They have been beaten up before, and I imagine they will regain this. But for right now, they're looking a little bit challenged. So I read the summary that I asked each of the teams to do. Why the picks? Brilliant recommendations or reasoning behind each of these picks. My only quibble, I won't even call it a criticism, is including Ethereum, which is not, it's not like the others. That's a little bit of an outlier. And it's a tough thing to say is a store of value in the same way that some of these companies are. This is very speculative. It goes up when people feel good about cryptocurrency. But NVIDIA makes a product that is in tremendous demand. It's a growth stock now. It's likely to get to a certain point, maybe the shares split, or they start paying a dividend, which would be more income to you. So, you know, lightning may strike and you do well here, but if I were putting this into my retirement portfolio, I'd be far more inclined to do NVIDIA in the same way that this team identified Microsoft as a long-term keeper. So great job on this. It was a very interesting portfolio to analyze.
Anthea, before you leave, because I'm having a hard time understanding this portfolio.
Okay.
I look at the price of 202 and the total, is that the current value, the 63 for Facebook as an example?
Facebook, the current value, they own 31 shares. They purchased them at $319 a share.
Mm-hmm.
It's currently worth 202, so it's down more than $100 per share. And as a consequence, their $10,000 is now worth $6,334.60.
I got it.
Mhm.
Got it.
Okay,
Thank you.
you're welcome. So team two, another interesting collection of companies, very well argued, really interesting read on how the thinking was. They have two semiconductor companies in here, which was really good. They have one that's actually been making money. It's smaller, it's been nimble, and that $10,000 is now worth an additional $338. Amazon, which seemed like a sure bet, managed to lose money. 20 bucks a share, not terrible. Will they recover that? It's down, you know, less than 1%, but it shaved their 10,000 to a little bit less than 10,000. Another interesting play, Hess, the oil and gas company. $93.50 per share for the purchase price. It's gone up a few pennies, 37 cents per share. So that's up just a little bit of money. Ironically, Exxon, which is much bigger in terms of their capacity, the size of the overall company, is down a little bit, down 1%. So the 10,000 went down to 9,500. So really strategic selections to go with, you know, the biggest retail company and successful online store, and these semiconductors, knowing that they are in such high demand, which has been pushing their share prices up. And these oil companies, which you would think in a crisis like this would be going up as people worry about supply. I think it's a timing difference. I think that if you looked at the same portfolio in a week, maybe a month, these two, you know, all of these companies will bounce back. So based on the fact that this particular portfolio has lost less money, done better, therefore, relative to the S&P 500, made a good case in terms of why, you know, their investment thesis for these stocks and how long they would hold them, I would declare Team 2 the winner of this particular contest.
Can we hear from the folks who are on the investment teams, why they made the various investment decisions? Can we hear a little bit from them?
Sure.
Yeah, so,
Okay.
oh,
Wait, team
Okay.
1 or team 2?
Team 2.
so yeah, basically the way we were going about it was that we originally just started out by getting the S&P 500 and Amazon S&P 500 because that's a required ETF, and Amazon because it's something that we all use regularly. And then where we started getting a bit more creative was with the choices of the oil and the semiconductors. So basically, we weren't even. What we did was we looked at the highest performing ETFs for 2021, and the highest performing one was this iShares ETF that tracked oil. So we looked at some of the highest performers inside that really high performing ETF, and that came out to be Hess and Exxon. And so there were a couple other smaller companies that we weren't as familiar with that were much more volatile and like had serious spikes during 2021, but we sort of edged off them because didn't necessarily have as much information about them. And then also for the semiconductors, we looked at like a couple ETFs that were high performing that were focused on semiconductors, and NVIDIA seemed common. And we also had come across this other company, the one at the top, ACLS, which stands for Axcelis Technologies. And we decided to take a risk with choosing that smaller one just to see what happened. So that's pretty much the reasoning right there.
It was well done.
Anyone else from that team?
Yeah, I think Andrew gave a good summary of the thought process we went through. He definitely carried the team. So yeah, good job, man.
So I'm a little bit surprised, given the supply and demand. You'd have thought that the semiconductors would have been performing better. Anybody have any explanation or any theory about why that didn't pan out?
I kind of feel like some of the markets or sectors that really rely on semiconductors have already started to transition to figure out how to not rely on them so much, given that it's such a heavy backup for so long. For instance, I think I'd heard that with the car industry, which relies heavily on semiconductors, that they're trying to find new ways to utilize less of them. And maybe in the future, there may be less features that are heavily reliant on semiconductors. So that was an example just from one sector that I think shows how companies are adjusting to using less of them given the shortage. But yeah, and which may drive the price down
In the future, but that's, if you're looking at current status, the supply is still limited.
right.
So this seems, everything you said is going to be, it will have some future impact on the market, but I'm not seeing how it's affecting the market.
I think that, I mean, sometimes stocks are affected by speculation, and even though it's a solution that may not yet have been implemented, the fact that we sort of hear it in the public can go ahead and affect the behavior of investors, which can go ahead and drive down a stock or drive it up. But in this case, it may have driven it down.
Interesting. How about team one? Well, Cindy has her hand raised.
I was just gonna jump in and say, perhaps because we can't get the raw materials to actually make the semiconductors and supply, just being able to make it. So if you can't make your product, you can't grow your business either. Just a thought.
It's true. That would impact sales.
Thanks, Cindy. Team one, we'd like to hear, understand your thought process.
So, well, the market was really volatile. So the most skeptical decision will be Ethereum. But after because I think Meta, like the whole Meta thing, the bad rap that Facebook got, cryptocurrency began to tank. But I was seeing a trend in a slight uptick, and when cryptocurrency gets any kind of good publicity, they tend to shoot up. So I was hoping to it wasn't the best logical decision, but I was hoping to quote unquote ride that wave. And it was a risk, and it's pretty large in size, and also it drives the market. The stock drives up quick when it does rise. For gold and the oil, I wanted an ETF in there, and I thought that since the market was really volatile, that people would start to try to stabilize their gains by going to natural resources, which is something that is constant in a volatile market. Nvidia is just a really big boom because previous trends show that it is shooting up pretty quick. It surpassed Enron, and also the two biggest or the highest weighted companies, I think, was Apple and Microsoft. And they make computers, so they would need graphics cards, and Nvidia makes graphics cards. So I thought that would be a sure shot win. And I use Facebook as a comparison, and yeah, that's the rationale behind each stock, and I kind of tried to keep it as diverse as possible to minimize excessive loss. But since the market is pretty bad, it's kind of hit or miss because I lost in a lot.
Oh, this is the first year we've tried to do something like this. First of all, I want to thank you all for participating. We're going to refine this next year. We just wanted to bring a little bit more interaction with the market as opposed to just getting financial information. And last comment for me is just, I want to thank Anthea again. You always bring a lot of energy, enthusiasm, and just common sense approach to finances. And I really appreciate you taking the time to do this for these young people, because as I say every year, I learned this stuff in my 40s. And I wish I'd had just a piece of this information when I was in my 20s and just trying to make some income. So young people, don't take for granted how important this information is that you're receiving at a young age, and go back and review it, because you're not going to remember it all. But just getting exposed to it at this early stage in your lives really going to set you up to be far ahead of your peers. So Anthea, thank you very much.
Thank you for having me.
Anthony, you want to close us out?
Yes, thank you all for joining, and we appreciate everyone's participation, especially in the stock game. I learned a lot from each session, and I look forward to getting out of financial debt from all of the things that I've learned. Please make sure that you visit the website to see if you have any loss, any money that you can recover from the website, because I do see that a lot of people in the chat said that they were able to find some money.
Great.
So please do that. Thank you
Two
again.
thumbs up.
The video will be edited and added to the website soon. I hope you got the first two videos, and this third and fourth will be finished at some point this week. So thank you all for joining, and have a wonderful night.
Thank you.
Thank you, everyone.
Thank you. Bye-bye.
Thank you
Happy
so
Black
much.
History Month, everybody.
Yes, happy Black History Month.
Thank you.